Financial Reporting Through the Lens of a Property Casualty Actuary. Part 3, SAP in the U.S., Fundamental Aspects of the Annual Statement. Chapter 8, the Statutory Income Statement, Income and Changes to Surplus. While the balance sheet is of key importance to regulators and the focal point of statutory accounting, the income statement is of equal importance to the ongoing viability of an insurance company. The income statement illustrates the revenue, expenses, and net income of an insurance company. The income statement is presented on the top portion of the statement of income on page 4 of the annual statement and provides the three sources of income before federal and foreign income taxes and dividends to policyholders separately: underwriting income, investment income, and other income. A sample of the statutory income statement for the industry as of December 31, 2018 is presented in Table 4. As shown in Table 4, the net income for the industry during 2018 was $60.8 billion. The subtotals for each source of income show that the industry experienced gains in underwriting, investment income, and other income during 2018. Each of the three sources of income is discussed further below. Underwriting income. Underwriting income is the most familiar and relevant source of income to most actuaries. Underwriting income is calculated as earned premium minus loss and loss adjustment expense, LAE, other underwriting expenses incurred, any aggregate write-ins for underwriting deductions, and net income of protected cells, not shown. We note that aggregate write-ins and net income of protected cells are generally immaterial, if not zero. Actuaries are typically involved in estimating incurred losses and LAE, and possibly in the calculation of earned premium, so these terms should already be familiar. On the income statement, each of the amounts labeled incurred presented also include the ultimate amount of those liabilities that occurred in the current year, and any changes in the ultimate amount of the liabilities that occurred in previous years, as shown in the formula below. Income statement incurred equals current period ultimate plus change in prior period ultimate, where change in prior period ultimate equals the total all periods ultimate at end of period minus total all periods ultimate at beginning of period minus the current period ultimate. Actuaries may be less familiar with the item labeled other underwriting expenses incurred. Further discussion on this other underwriting expense category is provided below. Other underwriting expenses incurred, line 4. We already encountered other underwriting expenses briefly during our discussion of the liability for other expenses, excluding taxes, licenses, and fees, in Chapter 7, Statutory Balance Sheet, a measure of solvency. The other expenses account represents all other expenses that were incurred but not paid at the end of the fiscal year. While this line on the income statement represents the total amount of other expenses incurred during the course of the year, whether or not they have already been paid. As shown in Table 4, the amount of the other underwriting expenses that were incurred by the industry in 2018 was $167.7 billion, which is about 28% of net premiums earned in 2018. The magnitude of these other underwriting expenses highlights the importance of other underwriting expenses to the profitability of the industry and the importance of ensuring that they are accurately reflected in the financial statements. Expense accounting requires that expenses be allocated in three ways. 1. NAIC operating expense classifications, which represent various types of expenses, some of which have subtypes. These 24 types are listed in the rows Underwriting and Investment Exhibit, U and IE, Part 3. Examples of these expense classifications are commission and brokerage, salary and related items, and taxes, licenses, and fees. It is suggested that the reader review the U and IE, Part 3, now to see the full list of classifications. 2. expense categories, which are broader groupings of expenses that align with the different operational functions of an insurance company. There are 3 of these broad categories: LAE, other underwriting expenses, and investment expenses. These categories are presented in the columns of the U&IE, Part 3. 3. Line of business, of which there are 33, some of which have sublines. These lines of business are listed in the U&IE, Part 2A. The lines of business used for expense reporting are similar to those lines of business used in Schedule P, but not the same. Each time an insurance company has an expense, the appropriate expense classification needs to be determined, and an allocation must be made by line of business and expense category. In some cases, the entire amount of the expense can be specifically identified with one expense classification, within one expense category, or for one line of business. For instance, a commission paid on a policy within a specific line of business. However, this is often not the case, such as the salary of an employee who oversees several products and functions. In those instances, an allocation of that expense must be made. Some expenses may require several allocation steps. When an allocation is required, it will be performed based on information that is relevant to that expense. Examples of potential allocation bases are policy counts, which may be appropriate in the case of policy administration expenses, employee headcount, which may be reasonable for supervisors' salaries, or other measures of business or employee activity. An example of a complex expense allocation would be one related to the rent that is paid for a home office that serves as a center for all operating functions. The allocation process could take place as follows. This expense can be specifically identified as the rent and rent items expense classification, and therefore assigned fully to that classification. Because the home office is used for all company functions, its expenses would need to be allocated between all 3 categories: LAE, other underwriting expenses, and investment expenses. One possible approach to this is to allocate the rent to those 3 categories by headcount of personnel associated with each function. The home office is also the base for all lines of business, so the expenses may be allocated to each line of business by premium volume. This allocation to line of business could differ by expense category. The result of the first 2 of these allocations can be observed in the U&IE Part 3, and the line of business allocation is reflected in the Insurance Expense Exhibit, Part 2, which will be discussed in more detail in Chapter 18, Insurance Expense Exhibit. Guidance for allocation of expenses is provided in the NAIC Annual Statement Instructions, and also in Statement of Statutory Accounting Principles, SSAP 70, Allocation of Expenses. These are the sources of the uniform classifications and categories that are described above, as well as additional allocation rules. In general, the guidance indicates that specific identification of expenses is preferable to allocation, but that when allocation is required, it should be apportioned based on pertinent factors or ratios such as premium, number of claims, or headcount. The decision to allocate and the factors or ratios that are used when allocation is required will require judgment on the part of a company. While the topic of expense accounting, and specifically other underwriting expenses, may seem of questionable relevance to an actuary, it is important to have a basic awareness and knowledge of the topic. The reason for this is twofold. First, the overall level of company expenses will directly affect the pricing, or the adequacy of pricing, of its insurance products. A company with lower expenses relative to its competitors has the potential to be more competitive and/or more profitable. Actuaries can contribute by participating in the planning and control of expenses. Second, if the relative allocation of expenses across functions and products is not accurate, it can lead to subsidies between products that may obscure the true profitability of those products and lead to inefficient allocation of resources or even anti-selection. An actuary who understands expense allocation can prevent or minimize such subsidies and their consequences by striving to allocate expenses as accurately as possible. The expense allocation process described above and presented in the U and IE is the driver of the other underwriting expense account on the income statement, as well as other references to expenses elsewhere in the annual statement. Investment income. Investment income is an important source of income to insurance companies and a unique aspect of an insurer's business relative to other industries. The importance of investment income was already highlighted by the summary of the industry income statement. There we saw that in 2018, the insurance industry's positive net income was nearly entirely attributable to investment income, with limited contribution from underwriting and other income. Because there is a delay, significant in some cases, between the time insurers receive premiums and the payment of claims, they have an opportunity to earn investment income on those funds. This makes consideration of investment income fundamental to the pricing of insurance products, which is not the case for most other industries. The investment income item on the income statement consists of the following: net investment income earned, and net realized capital gain or loss. Net investment income earned is primarily related to interest and dividends received on investment assets held over the course of the year. Net investment income earned does not include changes to the prices of invested assets that are sold. Those are included in net realized capital gain described below. Furthermore, it is recorded on an accrual basis, meaning that it is reflected in the year in which it is earned, and not necessarily the year in which the actual cash related to the income is received. The amount of this income is shown net of investment expenses and other costs, but gross of federal income taxes on the income statement. Net realized capital gain, or loss, generally results from the sale of investments for more or less than original cost, adjusted for the amortization of premiums or accretion of discounts, amortized cost. Realized losses also result from impairment adjustments. Certain investments, primarily common stock, are recorded at fair value. The changes in the value of these investments, unrealized gains or losses, are not included as income and instead reflected as direct adjustments to surplus. These direct adjustments to surplus are necessary because these items do not flow through net income for the current period, but the surplus must still be adjusted to maintain the admitted assets equal liabilities plus surplus relationship. In 2018, industry net investment income earned was $57 billion, and the net realized capital gain was $10.7 billion. Detail of both the net investment income and the net realized capital gain or loss amounts that are shown in the income statement is provided on page 12 of the annual statement, which includes the exhibit of net investment income, and the exhibit of capital gains or losses. These exhibits provide the detail of both sources of income by asset class. The exhibit of net investment income also differentiates between the amount of income collected and the amount of income earned in the year, and describes the deductions for investment expenses and other costs. The exhibit of capital gains or losses shows the split of the gains or losses between those gains or losses that were realized on the sale or maturity of an asset and those that were due to impairments, labeled Other Realized Adjustments. The details underlying these two exhibits are provided in Schedules A, B, D, DA, and DB of the annual statement, which describe the assets held in each asset class as of the evaluation date of the financial statement and the assets that were sold, redeemed, or disposed of during the current year. While property casualty actuaries are not typically involved in the investment reporting and valuation, they should have a basic understanding of these items due to their significance to product pricing and overall insurer operating results. For that reason, A discussion of the statutory reporting and valuation guidelines for each major asset class is included below. More detail will be provided on bonds and stocks because they represent the vast majority of assets held, but several other asset classes will also be discussed briefly. Bonds. Bonds represent a majority of the assets held by insurance companies. On the exhibit of net investment income and the exhibit of capital gains or losses, bonds are reported in 4 categories: U.S. government bonds, bonds exempt from U.S. tax, other bonds unaffiliated, and bonds of affiliates. The underlying detail is primarily provided in Schedule D, Part 1, Long-Term Bonds Owned, and Schedule D, Part 4, Long-Term Bonds Sold, Redeemed, or Disposed of. Bonds that mature in 1 year or less are reported in Schedule D-A, Part 1, Short-Term Investments Owned. The net investment income earned from bonds, as shown in the exhibit of net investment income, is based on the following 4 amounts. 1. Interest received during the year, Schedule D, Part 1, Column 20, and Part 4, Column 20. 2. Interest due and accrued, Schedule D, Part 1, Columns 19 and 20. 3. Current year's amortization or accretion, Schedule D, Part 1, Column 13, and Part 4, Column 12. 4. Interest paid for accrued interest on dividends, Schedule D, Part 3, Column 9. The first of the 4 items, interest received during the year, represents all coupon payments that were received on bonds held during the year. This includes coupon payments on bonds owned at the end of the year and on bonds that were owned at the beginning of the year but sold, redeemed, or disposed of during the year. This is presented on the basis of when the actual interest coupon was actually received, so an adjustment is required to convert it to an accrual basis. This adjustment is made by adding the change in the interest due and accrued account, the second item from above, over the last year to the interest received during the year. The explanation of the third item above, current year's amortization or accretion, requires us to revisit basic bond valuation. Recall that when a bond is purchased, the actual purchase price is usually different from the face value due to the difference between the coupon rate on the bond and the market interest rates at the time of purchase. To provide the buyer with an effective interest rate equal to the current market interest rate, the bond is sold at either a discount or a premium to the face value. For financial reporting purposes, that discount or premium is then realized as either positive, in the case of a discount, or negative, in the case of a premium, interest income over the life of the bond. This is referred to as either the amortization of the premium or the accretion of the discount, and is reported for each bond in Schedule D, Parts 1 and 4. The following example illustrates the accounting for a bond purchased at a discount. Assume a 5-year bond with face value of 100 is purchased for 90. The purchase price is less than the face value because the coupon rate on the bond is less than the current market interest rate. This difference between the face value and the purchase price is referred to as a discount, and the amount of the discount is set such that the effective yield on the bond will equal the current market interest rates at the time of purchase. The $10 discount is realized over the remaining 5-year duration of the bond as investment income in addition to the actual coupon payments, such that the effective yield in each period also matches the market interest rate at the time of purchase. The same example can be reversed for bonds that are purchased at premium, when the coupon rate exceeds the market interest rate, and that premium is amortized as negative investment income over the life of the bond to achieve an overall investment income equal to the market interest rate at the time of purchase. The same example can be reversed for bonds that are purchased at premium, when the coupon rate exceeds the market interest rate, and that premium is amortized as negative investment income over the life of the bond to achieve an overall investment income equal to the market interest rate at the time of purchase. The fourth and final item above, interest paid on accrued interest and dividends, is related to coupon payments that are received on bonds acquired during the year. When a bond is acquired between coupon payments, the buyer of the bond, in this case the insurance company, is required to pay the seller of the bond the portion of the coupon payment that was earned while they owned the bond. This amount is presented on Schedule D, Part 3, Long-Term Bonds and Stocks Acquired During Current Year. Column 9, Paid for Accrued Interest and Dividends. Each of these three items, interest received, accrual, amortization of discount or premium, interest due and accrued, and payments for accrued interest on purchases, is reflected in the investment income collected and earned columns in the exhibit of net investment income. The other aspect of investment income related to bonds, net realized capital gains or losses, comprises the following components: realized gain or loss on sale or maturity, Schedule D, Part 4, Column 16. Foreign exchange gain or loss on disposal, Schedule D, Part 4, Column 17. Other than temporary impairments recognized, Schedule D, Part 1, Column 14, and Part 4, Column 13. Before we discuss these items in more detail, we will first review the basic statutory accounting concepts for bonds. When a bond is purchased, it is recorded at actual cost, including brokerage and other fees. This amount is recorded as the actual cost in Schedule D, Part 1, Column 7, and Schedule D, Part 4, Column 7. In each statutory annual statement after the purchase of the bond is recorded at adjusted carrying value, which is based on one of two amounts: amortized cost, or the lower of amortized cost or fair value. Amortized cost represents the actual cost of the bond adjusted for the amortization of any premium or discount from the face amount, as described in the paragraphs above. Fair value generally refers to the value that an asset could be sold for in the open market. For bonds that are designated as National Association of Insurance Commissioners, NAIC 1 and 2, are carried at amortized cost. The adjusted carrying value of the bond is updated each year to reflect the amortization of premium or the accretion of discount. As a result, the adjusted carrying value of the bond will converge with the par value as a bond matures. For bonds that are designated as NAIC 3 through 6, the value of the bond is shown as the lesser of fair value or amortized cost. All of this information is summarized on Schedule D, Part 1, including the NAIC designation, actual cost, fair value, par value, and book or adjusted carrying value. To the extent the adjusted carrying value of a bond is adjusted to fair value, the adjustment is considered an unrealized loss and is reflected in Schedule D, Part 1, Column 12. Once the bond is sold, the difference between the consideration received and the adjusted carrying value is considered a net realized gain or loss and is recorded in Schedule D, Part 4, Column 18. Many bonds held by insurance companies are designated as NAIC 1 or 2 and held to maturity, so there is never any capital gain or loss over the life of the bond. Bonds denominated in a foreign currency will also be affected by changes in foreign exchange rates over time. These changes are reflected in the adjusted carrying value, but are unrealized until the bond is sold, redeemed, or otherwise disposed of. The change in the unrealized amount of this foreign exchange gain or loss is found on Schedule D, Part 1, Column 15, and the amount of foreign exchange gain or loss that is realized upon disposal is found on Schedule D, Part 4, Column 17. The sum of the realized gain or loss on disposal and the foreign exchange gain or loss on disposal equals the total gain or loss on disposal, which is shown on Schedule D, Part 4, Column 19. One important exception to the reporting and valuation rule described above relates to the third source of the net realized capital gains and losses, which is referred to as other than temporary impairments recognized. In general, an impairment occurs when it is deemed probable that the insurer will not collect all amounts due according to the contractual terms of a debt security at the date of acquisition. Whether or not impairment is temporary is a subjective judgment of the company. Impairments can occur on bonds with any NAIC designation, and they result in the realized capital losses even though a bond has not been sold, redeemed, or disposed. The total realized capital gain or loss for a year is calculated in the expense exhibit of capital gains or losses. Column 1 represents the realized gain or loss on sales or maturity, which is calculated in Schedule D, Part 4, and shown in Column 18 of that exhibit. Column 2 is labeled Other Realized Adjustments and includes the foreign exchange gain or loss on disposal and other than temporary impairments recognized in the first year. Stocks. Like bonds, investment income from stocks comprises investment income earned and realized capital gains. Preferred stocks and common stocks are reported on separate lines on the exhibit of net investment income and the exhibit of capital gains or losses, and they have separate supporting schedules, Schedule D, Part 2, Section 1 and Section 2, respectively. Disposals of preferred and common stocks are reflected in Schedule D, Part 4. Investment income for stocks is simply the amount of dividends received during the year, plus the change in the accrual for dividends declared but unpaid. Dividends are accrued on the ex-dividend date. These dividends are included in Schedule D, Part 2, Section 2, Column 11, for stocks owned at year-end, and in Schedule D, Parts 4 and 5, Column 20, for stocks sold during the year. When either common stocks or preferred stocks are purchased, the actual cost plus any commissions or taxes becomes the initial carrying value. Subsequently, the valuation of preferred stocks and common stocks differ, so each is discussed separately. Common stocks of unaffiliated companies listed on the major U.S. exchanges, NYSE and NASDAQ, are recorded at fair value. Changes to fair value after purchase are recorded as unrealized valuation increases or decreases in Schedule D, Part 2, Section 2, Column 13. When a stock, common or preferred, is disposed of, the difference between the consideration received and the original cost is recorded as a realized gain or loss on disposal, and a foreign exchange gain or loss on disposal, if applicable, in Schedule D, Part 4, Columns 17 and 18. The rules governing the accounting for investments in subsidiaries, controlled and affiliated entities are complex and beyond the scope of this publication. A brief description of the accounting for investments in insurance companies' affiliates is discussed in the RBC chapter of this publication. See Chapter 19, Risk-Based Capital, where accounting background is needed on the accounting for determination of the asset risk charge. The valuation of preferred stock of unaffiliated entities is dictated by the form of the instrument and the designation assigned by the NAIC Securities Valuation Office. The two common forms of preferred stock are redeemable and perpetual, i.e., non-redeemable preferred stock. Redeemable preferred stock, also known as callable preferred stock, is preferred stock that is redeemable at the option of the issuer at a specified maturity date or after a specified period of notice for a preset price. Perpetual preferred stock is preferred stock with no maturity date that cannot be redeemed by the issuer. For redeemable preferred stock, the highest two designation categories are recorded at the original purchase price, i.e., cost, plus brokerage and other related fees, with any discount or premium amortized over the life of the redeemable preferred stock. For perpetual preferred stock, the highest two designation categories are recorded at fair value. For redeemable and perpetual preferred stock, the lower four designation categories are recorded at the lower of cost, amortized cost, or fair value. As with fair value changes, market value changes to common and preferred stock after purchase are also shown in Schedule D, Part 2, Section 2, Column 13, as unrealized valuation increases or decreases. Again, when a stock is disposed of, the difference between the consideration received and the original cost is recorded in Schedule D, Part 4, Columns 17 and 18, as a realized gain or loss on disposal, and a foreign exchange gain or loss on disposal, if applicable. Both common stocks and preferred stocks are subject to impairment charges if there is a decline in fair value that is deemed to be other than temporary by the company. This determination must be made by the company based on available information, e.g., published reports or bankruptcy notifications. When impairment is made, it is recorded in Schedule D, Part 2, Section 1, Column 17, and Schedule D, Part 2, Section 2, Column 14, as well as Part 4 for stocks that are disposed of during the year. Impairments made in a given year are included in the other realized adjustments of the exhibit of capital gains. Each component of investment income from stocks is included in the exhibit of net investment income, page 12. Dividends received plus the change in dividends declared but unpaid are shown in the exhibit of net investment income. In the exhibit of capital gains or losses, the realized gain or loss on disposal is shown in column 1, and the realized foreign exchange gain or loss on disposal and other than temporary impairments are shown in column 2. Cash, cash equivalents, and short-term investments. This class includes assets that are immediately convertible to cash and have an original maturity of 1 year or less. Short-term investments are reported in Schedule DA, Part 1. Cash is reported in Schedule E, Part 1. And cash equivalents are reported in Schedule E, Part 2. The short-term investments presented in Schedule DA, Part 1, are composed of bonds or other securities with a maturity of 1 year or less at acquisition, and follow the same reporting and valuation rules as long-term bonds. When a short-term bond or other investment is purchased, the security is recorded at cost, and the premium or discount, if any, is amortized or accreted until maturity. Other than temporary impairments are also possible, though they are less common given the short duration of these investments. The reporting and valuation of cash and cash equivalents is similar, but relatively simpler than short-term investments, as evidenced by the fewer columns that are included in Schedule E, Parts 1 and 2, relative to Schedule DA. Derivatives. Derivatives are financial contracts between two parties for which the value depends on the performance of other assets or variables. While derivatives are not a major asset class for most property casualty insurance companies, they are becoming more common, and they are of heightened importance due to the financial crisis that occurred in the late 2000s. During the financial crisis, one large insurance group nearly collapsed due to derivatives that had been sold by one of its units. A list of outstanding derivatives owned, sold, or written, and terminated during the year is provided in Schedule DB. Companies that are not involved in any open derivatives may omit Schedule DB. Schedule DB provides the number of contracts for each derivative and the notional amount, which represents the number of units of the underlying asset that are involved. The original trade date and the maturity or expiration date are also provided. The two prices listed are the transaction price, which is the price that the company agreed to buy or sell at, and the reporting date price, which is the current price. One common reason a company may buy or sell derivatives is to hedge or offset the exposure they have to changes in price for an underlying asset or variable, such as an interest rate. For this reason, Schedule DB includes information on the item that is hedged with each derivative position and on the type of risk being hedged. If a derivative position is held for hedging purposes, and a company can demonstrate that the hedge has sufficiently reduced the risk related to the specific underlying asset or assets, known as a highly effective hedge, then that derivative may qualify for hedge accounting. Under hedge accounting, the derivative is accounted for in the same way as the asset that is hedged, which allows for any changes in the value of the hedged asset and the derivative to offset, or be unrecorded in cases where the hedged item is recorded at amortized cost. For instance, if an interest rate swap is held to specifically hedge the value of a bond portfolio, and that interest rate swap qualifies as a highly effective hedge, i.e., effectively neutralizes any changes in the value of the bond portfolio, then that interest rate swap can be accounted for on an amortized cost basis. If a derivative no longer qualifies for hedge accounting, i.e., is no longer highly effective, then the mark-to-market accounting method should be used, and any changes in the fair value of the derivative should be recorded as unrealized gains or losses directly to surplus in the current period. The accounting for derivatives used in income generation transactions depends on the nature of the transaction and the accounting for the covering asset or underlying interest. Schedule E is also related to derivatives and lists the counterparty exposure for all derivatives that are open at year end. Counterparty is the person or institution on the other side of a transaction. This is important because it provides information to the regulators and any other users of the financial statements regarding any concentration of exposure to a specific counterparty. If the exposure to a counterparty becomes large enough that it is material relative to the surplus of a company, it should be considered as a potential warning sign. Derivative accounting is very complex and beyond the scope of this publication. More detail regarding derivative accounting can be found in SSAP 86, Derivatives. Other sources of investment income. Although we have covered the largest and most common sources of investment income, there are other sources. For additional information on those other sources, or for additional detail regarding any of the sources discussed here, refer to the corresponding statutory accounting guidance. Investment guidelines. As discussed, there is a variety of investment asset classes available to insurers, and there is a wide range of specific assets within each class. When purchasing a bond, an insurer needs to make decisions on the type of issuer, e.g., government, corporate, or asset-backed, industry, quality, maturity, and country. Each company will make these decisions based on a set of investment guidelines, which are governed by state investment laws applicable to insurers. Each state has established investment laws, which provide guidance and limits regarding the allowable investments for insurers domiciled in their jurisdiction. Although the NAIC has established model laws governing various aspects of insurers' operations, including investments, the laws adopted by individual states may vary from those model laws. For purposes of this discussion, we will focus on the NAIC Model Investment Law. The NAIC Model Investment Law allows for two alternative types of investment guidelines, which are referred to as defined limits and prudent person. The defined limit system of investment guidelines follows a rule-based approach and prescribes specific quantitative limits for the invested assets that a company may hold. Examples of some of the prescribed limits include the following: a 5% limit of admitted assets with any single issuer, with exceptions for government bonds; a 1% limit of admitted assets with any single issuer with a designation of NAIC 3; a 0.5% limit of admitted assets with a single issuer with a designation of NAIC 4 or lower; 20% limit of admitted assets in all securities designated NAIC 3 or lower; a 10% limit of admitted assets in all securities designated NAIC 4 or lower; a 5% limit of admitted assets in all securities designated NAIC 5 or lower; a 1% limit of admitted assets in all securities designated NAIC 6; 25% limit of admitted assets, or 100% of surplus in all common stocks. The prudent person system of investment guidelines follows a principles-based approach and requires an insurance company to develop its own investment guidelines. If a company chooses to use the prudent person approach, it should develop the investment guidelines with the protection of the policyholder in mind, and it should consider the specific investment expertise and resources available. Measuring investment performance. Although investment income is a critical aspect of an insurer's profitability, it can be difficult to measure investment performance and make comparisons between insurance companies. Several factors to consider are the size of the asset base of a company, the level of risk inherent in a company's investment portfolio, and the impact of taxes on a company's investment income. Each of these considerations will be discussed below. It may be tempting to compare the amount of investment income from one company to another, or to create the ratio of investment income to written or earned premium. Neither of these approaches is an accurate measure of investment performance, because they ignore the size of a company's invested assets. All things being equal, a company with 10 times the invested assets of another company would also be expected to generate 10 times the investment income. For that reason, one metric to consider is the ratio of the investment income for the year to the average invested assets. That ratio will provide a basic comparison between two companies and how much investment income they are generating relative to their invested assets. However, this ratio does not consider the inherent risk to the assets that are being held. If one company has a significantly higher percentage of its assets in common stocks or lower rated bonds, it would be expected to achieve a higher investment return during a good year, but the level of risk is significantly higher. While there may not be a single ratio or metric that measures this inherent level of risk, it is at least possible to qualitatively compare the types of assets held by two companies to see if there are significant differences. Measurement and comparison of investment performance is also difficult due to taxes. As discussed earlier in this chapter, net investment income earned is presented on the income statement before the effects of federal income taxes. On the other hand, net realized capital gain or loss is presented after capital gains tax. Two companies that had the same net investment income earned may be subject to different taxation. The full implications of the impact of taxes on investment income are beyond the scope of this publication, but a user of the financial statements should be aware of this potential difference and seek input from a tax professional as needed. Other income. As shown in the summary of the industry income statement, the other income category is relatively small compared to the other two categories. For that reason, only a few of the significant sources of other income will be discussed below. Although they are not technically considered to be part of other income, dividends to policyholders and federal and foreign income taxes are also discussed below because they are part of the consideration of net income. Net gain or loss from agents or premium balances charged off. Line 12. In Chapter 7, Statutory Balance Sheet, a Measure of Solvency, we discussed the assets related to uncollected and deferred agents' balances. If a company determines that a portion of those balances will not be collected, those balances should be charged off as a loss and are recorded as an expense under this category in other income. Conversely, if an agent's balance that was previously written off is recovered, that recovery would be included as a gain in this category. Losses can be used to offset gains that occur during the same period. Finance and service charges not included in premiums. Line 13. Insurers will often offer financing or payment plans to the insured that allow the insured to spread out premium payment over time. Typically, the insured will pay an additional flat service charge to pay through these financing or payment plans. Those service charges are not recorded as a part of written or earned premium and are instead included in this category under other income. Aggregate write-ins for miscellaneous income. Line 14. While the amounts included as miscellaneous write-ins are not usually material, several of the common entries are the following. Gain or loss on sale of equipment. When furniture, equipment, or automobiles are sold, the sale price may differ from the current depreciated cost. That difference may be recorded as either a gain or a loss under other income. Retroactive reinsurance. An insurer may purchase reinsurance on existing liabilities, and the reinsurance premium paid may be more or less than the previously recorded value of the liabilities transferred. That gain or loss is recorded as other income. Gain or loss on foreign exchange. When payments are made or received in a foreign currency, the ultimate settlement of the payment may be at a different exchange rate than the exchange rate at which the payment was originally recorded, and the resulting gain or loss is recorded as other income. This does not include changes in investment income due to foreign exchange, which were already discussed. Corporate expense. Some insurers will record some corporate expenses that are not allocable to underwriting or investments, such as national advertising, to other expenses. Fines and penalties of regulatory authorities. As per the annual statement instructions, all fines and penalties imposed by regulatory authorities must be disclosed separately, regardless of materiality. Dividends to policyholders. Line 17. The board of directors of a mutual insurance company may elect to pay a dividend to the policyholders. A dividend is effectively a return of a portion of the premium that was originally paid by the policyholder, and for a dividend to be paid, there are typically state requirements. When the decision is made to pay a dividend, it is considered to have been declared, and payment won't actually be issued until a later date. This item on the income statement includes dividends that were actually paid, plus the change in accrued dividends. Federal and foreign income taxes incurred. Line 19. All foreign and federal income taxes that are incurred during the current year, including amounts related to prior years, are recorded on this line. This amount of income taxes incurred represents an estimate of the current income taxes incurred during the reporting period and excludes any amounts that would be deferred to later years. Further detail on taxation appears in Chapter 26, Taxation in the U.S.